My husband and I decided to purchase an RV in 2011. It was after I graduated from law school. The goal was we have to get out of debt.
That's Alicia Wilson, an attorney who started off with a lot of debt and then later dove into real estate.
Between his undergrad, my undergrad, and then the law school loans, I think we were somewhere around $200,000. And that was just a daunting amount of money.
In this episode, you'll learn how she snowballed her debt down to zero.
We can work together and how much of the extra money we make we can put on these loans. And it really did snowball.
How she quickly grew her cash savings by living in and then flipping 2 of her residences.
We bought it for $570, sold it for $835. Just a little over 3 years later, our eyes were kind of bugging out.
And how she used those cash savings to buy 2 new rental properties plus her new principal residence.
We bought just the one in Mississippi. That was early July 2023. So 2 weeks later, we closed on another new construction home in Lockhart, Texas.
And now we're going to dig into all of that and more. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson. And this is a show to help you get out of the financial grind so you can spend your time doing more of what matters. And now let's get to the interview with Alicia. If you're up for it, I'd love to go back in time. Here we are in 2024. Let's even go back maybe to 2011, 13 years ago, maybe earlier if you want to. I'm just curious, but if I remember that part of the story, you and your husband were living in an RV at that point, and you had student debt, and you were in a little bit different place than you are now. So can you just take me back to that point? Let me know, what were you thinking about? What were you shooting for at that point? Was it real estate even in your horizon at that point?
Sure. So my journey in real estate actually started a little bit earlier than that. I bought my first home at the age of 25 in 2005. And this is when they were giving loans to anyone with a pulse. And I bought a small home, 3-bedroom, 2-bath, and it was $108,000. That's back when you could get a pretty decent house for that amount. And I house hacked. And that was before I knew what house hacking was. I had my friends come and rent rooms from me and had, I think, $400 to pay on my mortgage. And we split all the bills. So I knew the power of real estate from a very early age, just from doing that. My husband and I decided to purchase an RV in 2011. It was after I graduated from law school. And the goal was we have to get out of debt. We had so much student loan debt. So I think we were between his undergrad, my undergrad, and then the law school loans, I think we were somewhere around $200,000 or pretty close to that. And that was just a daunting amount of money. And we just thought, how are we going to pay this off? And so my dad is an avid RVer. And so he said, well, why don't you guys live in an RV? And we thought about it. He said, okay, we'll take a look. And we found this big, huge 37-foot Class A RV. And it seemed like a 1-bedroom apartment, it was small, but we worked it out. We had 2 dogs in there, and, we were in there for nearly 5 years, and we were able to pay off, all the student loan debt and our cars. So it was great. It was very cheap.
Well, I'm curious about 2 things. I want to know some of the financial details too, but your mindset at the time, both with your house hack in 2005 at a young age, and then also doing the RV, it's a pretty unorthodox thing. Not everybody just says, okay, I'll live in a house with roommates. I will, go do an RV. What was the motivation behind the scenes? Was it just like, I just got to get this, I'm just kind of fed up with the debt, I just want to get it paid off? Was it, I'm just curious if you had did other people help plant that seed? Were you reading books at the time? Because those are both pretty interesting decisions for that most people wouldn't make.
It was sort of a 2-part thing. So first, the way that I grew up, unfortunately, my parents were not good with money. And so I sort of came from a scarcity mindset all the time. I was always worried about money and whether we'd have enough money. And I still fight that today. So that was the first part of it. But the second part of it was my husband and I were reading The Total Money Makeover by Dave Ramsey. And so we read about that Snowball And we thought, oh my gosh, this is really cool. Like, we want to do the Snowball. And we read that when we were in the RV, and that's what made us initially think, let's start paying, see if we can pay off the student loan debt and how fast. And it sort of became a game to us. Let's see how much we can work, how much overtime we can work together, and how much of the extra money we make we can put on these loans. And it really did snowball. And it was really interesting seeing the method work before your eyes. And so then it sort of became addictive. We got an adrenaline rush, every time we're like, put $2,000 on the loan,
Yeah.
So that's really what I think prompted us to pay off the student loans, was that book.
For those who haven't heard of a debt snowball, could you explain just kind of the highlights of what that means and how y'all did it?
Sure. So the way that we did it was we took so you can take the highest balance first or the highest interest rate first. And the way that we did it was we wanted to do the highest balance first, and that was our student loans. And so we started chipping away at the student loans. And the point is as you pay things off, then you move the money that you are putting on that thing to the next thing. So, and every time you pay something off, you no longer have that payment anymore, so that you can basically snowball that money into what you were already putting into a payment. And it just gets bigger and bigger and bigger until you're making like $10,000 payments on the one thing you have left, and you get it paid off in, 3 payments. So that's how we did it.
It's very psychologically satisfying. My wife and I have done kind of our own version, and we saved up the cash and paid it off. Or in our rental properties, we've done some little debt snowballs, and there's something psychological, at least, for a lot of us, it's like a game you mentioned, like to be able to pay that off and see the progress. And because there's so many things in life that are like ultra marathons, whereas you're taking like a 20-year loan or a 30-year loan and you're paying it off in like a year or two. Like that's pretty cool. That's fun.
It is cool. The student loan, I think it was the law school loan. I think that one I had a 20-year note on it. And I just thought, oh my gosh, I'm going to be, 60 years old, still paying off this loan. And I just didn't want that to happen.
So you focused on it. You went to law school, and if I remember right, you were both in the insurance adjuster business. Is that right? So it's kind of a unique situation with RV, in that you had to travel all over the country to wherever like the biggest storm was, or they had a lot of hailstorms. They had a hurricane here, and you would go travel there to do your insurance adjusting work. But you could travel with your RV, which was pretty cool. You got to take home with you. So you're making money, you're living in your home. What would that have compared to, just to kind of put a financial spin on this? Like what were your payments on the RV, and what would that have compared to maybe if you would have just rented a house or bought a house or done something like that?
I don't think we could have found a house for as cheap as we were living in the RV, because our RV payment was also stretched out for 20 years, and it was a simple interest auto loan. So it wasn't compound interest like a mortgage. So the payment, I think, was around $600. And then we had lot rent for $400, and that included, electric and all of that. So, we were paying $1,000 a month for this RV. And at the time we were in South Florida, and, I don't know at that, even in 2012, I don't know of any apartment that was that cheap. And even if you did get it that cheap, you would still have to pay, utilities. So, yeah, I think at the bare minimum, if we had an efficiency, or if we had lived in an efficiency, we probably would have paid anywhere between $1,500 and $1,700 bills and everything. So,
and you would have been renting, and it would have been a little bit more difficult to have pets and to live your life. So cool. You turned to like the season of your life, which is, I've got a lot of debt. We need to get this taken care of. Let's just find a fun way to like make this thing happen. And so was that like 3 or 4 years total that you did that?
Oh, goodness. I think we started it in 2012. And we were still paying things by 2018. I would say 2018 was when we got everything done. So it took us about 6 years to do all of that. But I've been known to plug away at things. Obviously law school, I started out part-time, and I had to plug away at that while working a full-time job. So I've always been able to sort of stay in it for the long term and suffer. So I'm very good at suffering for a long time.
That helps with investing, doesn't it? Especially on the front end.
It does.
You can see the rainbow way off on the horizon and say, all right, I'm going to suffer to get to that point. That's good. So you made it work with the RV. You lived there. That was that season of your life. But then there was another foundational period where you moved on from the RV and started getting into not technically house hacking, but where you're living in a home and then eventually selling it and flipping it. And so I'd love to hear, could you unpack that and how that period of life worked, what the houses look like that you got into next?
Sure. So after, several summers in Florida in an RV, we decided, okay, we can't take this anymore. We need to have a house with an air conditioner. And so we bought a new construction home in 2015 in South Florida. It was a suburb of Fort Lauderdale. And we lived in that for 5 years. And then we had a ton of equity. So in 2019, we decided, you know what, we're going to move to a bigger house, something in a more established, desired neighborhood. And so we found a neighborhood that the homes were built in the 90s, but they were really large on really large lots. And most of the people in the neighborhood were, people in their 50s and 60s, close to retirement. And we found probably the ugliest house on the block. The roof looked like it was original to the home. The outside was just ugly, ugly color. And we were able to get a good deal on that one. I think most of the homes in the neighborhood were selling for like $650, $675, $700, and we got it for $570. And we used the equity in our new construction home. We sold it and we had 6 figures of equity, and we just moved it over to this resale home. And we didn't really have much larger of a payment than what we had in that much smaller cookie cutter house that we had been in for 5 years. Otherwise, I was never comfortable spending over $500,000 on a house, and it kind of gave me heartburn.
Yeah.
But because we were able to transfer that equity, we essentially had a purchase price similar to the smaller new construction cookie cutter house. And yeah, so that's when we started making it pretty.
Yeah, what I love about that part of your story, Alicia, is that it's using your residence. Like, to me, like the best way to start in real estate. You started with RV and you had like the debt payoff period of your life, which, if you're in debt, you just got to focus on that. And then you free up your income, which you're both making good income now, to be able to go to the next thing, which is you put a down payment on a house. Nothing like, not a burst strategy, not like these spectacular things that everybody talks about in the podcast, but just I got to move into a house. I'm moving to a new construction house. You make it a down payment. You paid your loan down and the house went up in value. So you've got this equity, 6 figures of equity in the house. And so you leverage that by selling that house. And the cool thing, just for people, I know you know this as an attorney, but maybe could you talk about the fact that you didn't have to pay taxes on that when you sold your residence? One of the best things in the whole tax code is the tax benefits. Maybe could you unpack that and how that benefited you on buying that second house?
Absolutely. So the equity that we had in that first house, it was under $500,000, and it's $250,000 in profit per person. So my husband had his $250,000, I had my $250,000, but we could make up to $500,000 of profit on that house and not have to pay taxes on that profit. And so we essentially were able to transfer money that we didn't have to pay taxes on into the purchase of this other home.
And to put that in perspective, I'm just going to pick a number. Like if you had $100,000 and you were to go make that at a job, to actually have $100,000 to put in the bank to go buy another house at a high tax rate, you might have to make $150,000 or $170,000 or $200,000. So you basically took what many people would work, years for to earn. You had equity in your house. You took advantage of that. And then traded up to your next house. In this particular house, that was a fixer upper, right? So it was something that had some potential to increase the value again. And so maybe talk about how that went. How long were you in that house? What kind of things did you do to that house? And let's talk about where you went from there.
Sure. So we were in that house for a little over 3.5 years before we sold it. But when we were there, we redid everything on the exterior. So we put on a brand new tile roof. We installed impact or hurricane resistant windows and doors throughout. We restuccoed a lot of the exterior and completely repainted it. We put in a brand new pool deck and, new tiles in the pool and resurfaced the pool. And we put a bunch of really beautiful landscaping in both the front and back of the house. And then on the inside, took out the ugly 90s popcorn ceilings and put knockdown in. And then we refinished the bathtubs and the sinks. So there's this really cool process where instead of having to rip stuff out, you can just make it beautiful and white by, I think we did Miracle Method or some company like that came in and just made it beautiful and white again.
It's like resurfacing, basically a new, I don't know if it's epoxy. I don't know what the actual surface is, but it looks beautiful if you get a good job done.
Yes. And so we, and the kitchen was pretty decent. It was a beautiful kitchen. And that was one thing that sold us, was the kitchen was just amazing. The countertops were probably 90s and the wood cabinets were sort of that maple color that was popular in the 90s. But we didn't really have to do anything, to the kitchen at all. And so we repainted all of the interior walls, and I think we steam cleaned the tile floors to make those look nice. But that was sort of the majority of the things we did. That mostly was on the outside to give it really nice curb appeal. And it was just beautiful. And our neighbors would always stop by and say, "Oh my gosh, like you made this house look amazing." I guess the neighbors didn't really like the prior owners because they said they just didn't care. But we really did love that home and we really cared about it. And we probably would still be there if I hadn't been homesick and wanted to come back to Texas.
So you made a decision from a life standpoint that, hey, we're moving back to Texas. We're in South Florida now. And at this point, you had been there. I mean, we didn't even talk about before, but you've been there the 3 or 4 years with the RV, the 3 or 4 years with your first house, and now another 3 or 4 years, I guess, with the second one, right? So 10 to 12 years, call it like that. Is that about right? Yep.
Yeah, it was in total about 10 years, a little over 10 years.
Okay. So I want to, two things. Let's talk about what did you sell the house for when you decided to move? And then I want to put just a pause on that, just to kind of reflect on this period of time, because I know a lot of people that I've talked to who are just starting and investing, we're going to talk about your rental properties, which I think are really interesting. But I think everybody forgets about like this prior period where you don't even have to own rental properties, but yet you're making progress. Like you pay down a couple $100,000 worth of debt. You built equity, 6 figures of equity in a house. We're going to talk about the equity you built in the second house, but all of this was not even owning a rental property yet. And yet the whole goal is just to increase your net worth so that you can then redeploy it, which we'll talk about. But so maybe could you talk about that and what you sold the property for at the end of this period?
Sure. So the sell price on it was $835,000. And that was after only a little over 3 years of living in it. So, we bought it for $570, sold it for $835, just a little over 3 years later. And our eyes were kind of bugging out because that's not something that we expected. And this was in 2023, mind you. We listed it in October of 22, sold it in March of 23. And we were having panic attacks weekly because the interest rates just kept shooting up. Yep. And, in that price range, we're thinking, oh my gosh, we have to either get a cash buyer or someone who can make a significant down payment with these interest rates. So it was slow at first, and we didn't know if we were going to be able to sell it at all.
But you found a buyer, you got that done. And
we did.
Okay, great. And so I guess the reflection part of this period is like, how did it feel for you? Like, I don't know if sometimes we're so busy that, I know my own life, I don't often reflect on this, but did you ever look back at this and say, all right, 11 years ago, or even back to your house hack days, I was in a certain place and look at me now, like we have multiple 6 figures of equity in a house, cash that we can go use to do something else. We've got our debt paid off. Like, I don't know. I just want to see what was your mindset at this point with this period of your life?
Well, during COVID, I was thinking about us moving back to Texas. And I thought, what are we going to do with this house? What are we going to do? We put all this money into it. We made it look so nice. Do we want to rent it? What are we going to do? And so I started doing searches on the internet, how to rent your house or how much can I rent my house for? And BiggerPockets came up. And I started reading the articles and I thought, what is this? This is interesting. And I just went down the rabbit hole of BiggerPockets and started listening to all the podcasts. And I came across your podcast, started listening to your podcast. And I, did that for like 6 months during COVID. And so I knew that I wanted to do this. I thought, okay, we're going to sell this thing and we're going to use that money and buy a bunch of rental properties. That was my idea. I thought we can become, wealthy, and I won't have to work until I drop dead, in my 80s, or hopefully in my 90s. I don't know. But that was sort of what got into my mind, and that bug was implanted. And I thought, okay, I'm going to do all these things. I have to prepare. And so that's when I started running calculations on different homes off of Zillow, and, just trying to figure out how to really run numbers, so that whenever I was ready to pull the trigger and we had the money, that we could just, hit the ground running.
Got it. So there's a period of financial preparation in terms of paying off debt and building up your equity. And then there's this knowledge preparation of saying, I just need to learn how to run the numbers. I need to learn the vocabulary. You just did a crash course, went down the rabbit hole. And I'm glad to hear that I was on the same rabbit hole as BiggerPockets. So that's good. We're in the same boat there. And by the way, people listening who are new, that BiggerPockets published both my books, The Small and Mighty Real Estate Investor and Retire Early with Real Estate. So lots of good stuff there. So let's talk about the transition. And so we're going to deep dive on one of your deals as well. But you had this idea that, all right, I've got wealth here. We've built some wealth. If I'm strategic with this, I might be able to really make an impact on our life financially. So what were the moves you made? You obviously made a move back to Texas. Did you rent a house when you started? Did you buy a new house when you got there? Like what was the kind of the personal transformation there?
Oh, Chad, of course I bought a house.
All right. You're an owner. Yeah.
Yes, I will never rent. I mean, there's some people who say, well, I'll never buy. Well, I'm the person who says I will never rent ever. Yeah. I will never throw my money away. That's, my opinion. Obviously, there's costs associated with either thing that you do, but I'm an owner for life.
Yes.
But yeah, we bought a new construction home. We went under contract on a home just outside of Austin in March of 22, at the height of the market. We have really good timing, let me tell you.
I'm the same way. I bought a bunch of properties in 2007, right before the market fell off a cliff. So I'll join that party. I'm with you.
Okay. Well, that's good. At least I'm not alone. But I will say our agent did a fantastic job, because by the time we closed in December of 22 and all the property values had gone down in Austin, she negotiated a discount on the purchase price. And you know how those new home builders are. A lot of times they say, you signed a contract, sorry. But I think they were feeling the brunt of the increase in the interest rates. So they were amenable to giving us a fairly large price discount for us not to walk away. We wouldn't have walked away, but they don't need to know that.
Right. Negotiating. Yes.
Right.
So it sounds like if we're looking at like the different plays in your playbook, you lived in a new construction rental or new construction house earlier in your life. And so you're moving to Austin, the place where you want to be near family, and you're buying another new construction rental. I want to start unpacking your mindset, because I think I've been really impressed with the type of rentals you buy. And there's this, I've been on a kick lately talking about quality rentals and quality locations, like pretty properties in the path of progress is kind of the term I'm using for that, PPPP. And you seem to be like somebody who just figured that out. What were you thinking of? What were your criteria, both for the residents, but also as we're thinking about your rentals that you're about to buy? How do you think about like your buy box, like what locations and the types of properties you buy?
So by the way, I did read your retire early with rentals. And so a lot of the stuff that I did was things that I learned in your book.
Thank you.
And it was very, very helpful. And that's one of the reasons I liked your podcast, is because you are a real person, and you don't just tell about all the fantastic stories about investing. You also talk about, the downsides. I mean, there are downsides to investing, and it made it more real for me, because I could, in my mind, think, okay, there's a possibility this could go very wrong, but here's what I would do if any of these things happen. This would be my plan of action. I'm a big plan of action person. My husband always tells me, like, can we just focus on today? And no, I need a plan for, a year from now. Where are we going? But my thought was, I need to have something where we can buy it and at least make $100, like be $100 positive after the mortgage, taxes, insurance, all of that is paid. If we can just make $100, then I would be happy with that because we'd be covered. And then I knew from researching rental amounts, what you could get for rent. I knew that in the Texas market, you would need a 4-bedroom, 2-bath to get the highest rent you could get. And so my focus was 4-bedroom, 2-bath in Texas. And I wanted to do new construction because we actually bought a house in Austin in 2018. And that was my first attempt to try to come back home. And when I realized that attorneys there got paid a fraction of what attorneys in South Florida, got paid, I thought, okay, well, we'll have to scratch that. So we bought the house intending to move into it, and then it ended up becoming a rental because I couldn't find a job making the amount of money I wanted to make. And that was a 1965 3-bedroom, 2-bath over a crawl space. And when I tell you that I wanted to pull my hair out every year because some CapEx got us, that would be an understatement. They remodeled the house prior to selling it to us, but we came to find out that the remodeling it must have been a DIY situation because they did some questionable things that our home inspector didn't catch. And so every year it was something: AC unit, water heater. One year there was a freeze and it killed 2 very large trees in the front yard that we ended up having to remove and grind down. So it was just, a negative cash flow every year.
You learned one of the biggest lessons. It took me a while to learn it as well, but how expensive these big capital expenses can be. They're not something that happens every month, but then when they happen, it's $5,000, $8,000, $10,000, which eats up years of cash flow, right? It's like so it sounds like you, tell me if I'm reading this right, is that you realize that maybe where I am, where you are and your husband, you're making good income, you're doing this on the side, you're not doing this as a full-time job. It would be better to have a low maintenance property that doesn't have as many big CapEx. It's probably easier to manage. You're going to pick a good location and you're just going to play the long-term game, which you've already kind of learned from South Florida as well. You're going to play the game of buying in a good location, making sure it pays for itself, but then hold on and let it go. Am I saying that right in terms of what your strategy was?
Yes, that was exactly our strategy. We both work busy W-2 jobs and we're high income earners. I think they call us dinks, dual income, no kids. And, we could cover if something, if we had an issue, and we could cover, the old Austin house when we had those issues with CapEx, but we just got tired of having to do that. And I thought, we have to have some positive here and there so that not every single property we buy is a negative on our finances. And so that's what made us think new construction. We're not handy people. We hire out everything. And the renovations we did on that South Florida house, we hired every single company that did the work. And so new construction seemed to fit that need for us.
Yep.
And, the Austin area, it's too expensive right now. And even then in 2022, it was way too expensive to buy something in Austin for a single family primary residence, much less a rental property.
Can you give some examples? And I know that people live in different areas who are listening to this, but when you say too expensive for a rental, like what were some example prices and what would that same house rent for? Just to give people a context on that.
Sure. So some of the houses that we were looking at in Austin proper, they were, so the D.R. Horton is really big there. I think they originate from Austin, Texas, the company itself. And they were selling in North Austin, 4-bedroom, 2-bath homes. And they were anywhere from $450,000 to $500,000. But the rent at the time that you could get would only be $2,200 a month.
If we use the 1% rule as like a proxy of a pretty good cash flow deal, you're about a 0.5% rule, right? Somewhere like.
Yes.
Got it.
Yes.
So maybe you could technically cash flow if you made like a 100% down payment, but it's not going to be, probably not going to be considered like the best rental property deal. And so for people on the West Coast, California, they're going to recognize these numbers as well. You have $600,000 houses that rent for $2,500, $800,000 houses that rent for $3,000. So you're in kind of this high income area, high price area. and you buy your own principal residence there and make that work. You've got your 2018 house. If we're keeping score, you sell your house in Florida, you got a rental that you had bought before in Austin, and you've got your personal residence in Austin. But if I remember right, you still have some cash to deploy. Is that right? You still have some more money you're going to put into work after that?
Yes, we do. I mean, after it was all said and done, after we got back, our refunds from our escrow account, our insurance policy, after we sold that South Florida home, we were just under $300,000 of cash to deploy. And we kept it in a high interest savings account while we were waiting. We were sort of waiting to see, what was going to happen in the market. And we found a high interest savings account that paid, I think it was 5.15% interest. So we stuck all of that money in there just to figure out what we were going to do, get into our house that we had just purchased in Texas, and figure out where we were going to deploy it. And so the first thing that I did was from another podcast called The Remote Real Estate Investor, which I don't think is active anymore, but I had been listening to those podcasts because I was also interested in other markets. And that podcast interviewed agents from different markets that Roofstock likes to advertise to their investors. And one of the markets was Jackson, Mississippi. And there was an agent that was on actually two different podcasts on that podcast. And she was talking about the surrounding areas of Jackson, Mississippi. There was a town called Madison, Mississippi, and then another one called Canton, Mississippi. And she talked about how cash flow was really great in those areas. And so I reached out to her and I said, hey, I heard your two podcast episodes and I'm interested in the market. Can you tell me more? And so she basically gave me some examples. She sent some listings and she said, okay, this is what you could probably get for rent on this. This is how much the taxes would be. This is how much the insurance would be. And I could plug in the numbers, on the mortgage and the interest rate to sort of do my numbers. And it was great because it looked like I was going to be able to make anywhere from $300 to $500 a month in cash flow, after PITI. So principal, interest, taxes, and insurance. And so I thought, okay, this would be a good market to also have rentals in. So I could have Texas, which is more of a appreciation play. And then I could have, Mississippi, which is more of a cash flow play. And so we found a new construction home. It was a 4-bedroom, 2-bath on a really large lot. And the purchase price was $269,000. And this was a really nice house. And my husband went and saw it with me and he said, wow, I would live in a house like this. This is really nice. And that's sort of what we always wanted to do is, okay, if we're going to do this new construction thing, we want to buy something that we would live in ourselves. We don't want something that, is not going to be desirable to a renter. So that's kind of how we decided on the new construction and which ones we were going to buy.
Awesome. Just out of curiosity, what did that $269,000 house, what was it projected to rent for? Then also, what is it rented for since then?
Sure. So at the time, I think she said it would be like $2,400, or she said $2,300 to $2,400 is what it would probably rent for. And after we bought it, my husband and I drove up to Mississippi for the closing, and we went, and I was going to self-manage this thing because after reading your book and listening to podcasts, I thought I can, remotely self-manage these things. I can do it. And so I got myself prepared. I got a property management software online called Hemlane. I bought a door lock that I could use on Bluetooth. And I was ready to go. I was like, okay, I'm gonna do this. I got it all under control here. And the first, we had a lot of inquiries, but some of the people in Mississippi, they just didn't understand the technology. So that was interesting, but I got lucky because a week after we listed it, a company called ALE Solutions contacted me and said, hey, we house for insurance companies who have insureds who have, lost their home due to fires, floods, whatever. And we would like to place a family in your home. And I, being in the insurance industry, immediately knew who ALE Solutions was. And I knew that you can charge a premium for the rent and they will pay it because you have to still cover all the utilities. And so I sort of quickly did the math and I said, yeah, I can rent the home to you for $4,000 a month and I'll cover all the bills and the lawn care and all that. And they got back with me the following day and they said, we can do it. We want to do a 6-month lease to start and, we'll extend if needed. I still did the background check on the tenant just to make sure, that they didn't have a criminal record or anything like that. And they loved the house. They wanted to move in. I didn't have to put a fridge in there or a washer and dryer. They had all those things already. And when I tell you this was the best tenant I've ever had in my life, it was amazing. She treated that home like it was her own house. And by the time she moved out 8 months later, you couldn't even tell that anyone had lived there. It still looked like a brand new home. So that was great. So we were way, way ahead.
Yeah. You got like 16,
in cash flow.
Like 16 months of rent equivalent for 8 months, right? So,
right. And I think she actually extended a 9th month because she was closing on another house because hers was a total. And so she asked me for another month and I said, sure, I'll do it for $2,500, which is what I would have rented it at anyway. And I went ahead and paid the bills for that month. So she paid me out of her own pocket the 9th month. And we were able to put it back on the market actually in April.
Got it. So are you still self-managing then? I
am. So I just rented it May 1st to a tenant for $2,500 a month.
Great.
So, and they're going to be paying the bills. So no more bills for me on that property.
So you sort of stumbled into a midterm rental where you get a premium rent for a shorter term. And then now you're back on the kind of normal track, your long-term rental track. But even so, just going back to the big picture, I love you got 2 different markets for 2 different purposes. You got the same strategy, brand new property in a nice neighborhood and something that has low maintenance, something that's easier to maintain. But then you have $269,000 purchase for a $2,500 rent. So pretty close. If you run the numbers on that, you're definitely gonna do better than you were buying in North Austin somewhere. And then you have your Austin residence plus your Austin other rental. So at this point, you have 3 rentals total, 3 single family house. Well, including your residence, three houses, or did you buy a couple in Mississippi?
We bought just the one in Mississippi. That was early July 2023. So that was the first acquisition with this money that we had sitting in the high interest savings from the sale of our Florida property. The second one came very quickly. So 2 weeks later, we closed on another new construction home in Lockhart, Texas. And that's about 30 minutes south of Austin. And it is located very close to a Tesla plant. So Tesla came in a few years back and put in this huge Tesla plant where there's thousands of employees that work there. And because of that, builders have been building pretty much nonstop for the past few years in Lockhart and those surrounding areas. And they're located, about 20 minutes from that Tesla plant. And so that area was not on my radar, but my real estate agent at the time, who's also an investor here in Texas, she said, hey, I'm buying a D.R. Horton home in this neighborhood in Lockhart, and I really think it's going to be a good investment. And we ran the numbers, and they were offering incentives, $20,000 even to investors of incentives. And so I ran the numbers, and I thought, okay, it's not like going to blow me away. You're going to make, I think, $90 or something in cash flow. But the appreciation potential was incredible. Well, and so that's why we pulled the trigger on that one.
Got it. Okay. So you were networking, you were talking to agents. I love how you just run out and talk to people. You listen to a podcast, you take action, you call an agent, you have this other real estate agent. What were the numbers on just the basic numbers, purchase price, and then the rent on this Lockhart property?
Sure. So the purchase price on it, I negotiated. My agent actually was a little nervous, but I because I'm an attorney, I love negotiating. And so, the purchase price, they wanted $320 for it. And she had purchased her home, I think, for $315. And I said, I'm going to ask them for $300. And she looks at me and she says, Alicia, they're not they're probably not going to do that. I said, I don't care. I'm going to ask them anyway. And they accepted it. They accepted the 300,000. And I looked at her and kind of smiled, and her mouth fell open. She thought, oh my gosh, I can't believe they accepted that. And I'm like, you don't know unless you ask, you can't know unless you try. And so I think I added like some blinds and a garage door opener. So like the total price ended up being $301,185. And I got a 5.875% interest rate. Because that was another thing. I used part of the $20K to buy down the rate at the time. It was, I think we went under contract.
Let's talk about that, because I think this is one of the things I learned from your deals that is happening out there that a lot of people might not realize is when you buy from new construction, not only is it the benefit is you have a low maintenance property, but a lot of builders in an 8% interest rate environment are willing to do this thing called a rate buy down. So could you explain how that works? You ended up getting a 5-point-something% interest rate for 30 years when other market rates are 8%. How does that happen?
Right. So the builder so this is D.R. Horton. They have their own mortgage company and their own insurance company, by the way. And their mortgage company was willing to let me use some of the incentives that they were offering to buy down the interest rate. So I think at the time it was pretty close to 8%. But I told him that, the interest rate needed to be below 6 in order for me to really be able to make this work. And so he was able to get the 5.875 by using some of that $20,000 in incentives to essentially pay a discount price, or basically you're paying some of the interest up front in order to buy it down for the 30 years. And since it wasn't my money, I thought, sure, if I can use incentives to do that all day long, I'm going to buy down that rate. And so that's what I did. I would say the grand majority of it I used in order to buy it from like a 7.9 down to a 5.875. It cost almost all of that $20,000.
Yeah. And again, as a long-term rental investor, which you are, you're buying in locations that you've chosen for the long-term strategic, place where they are, and you're thinking this is going to do better over time. You're a patient investor. You're a long-term investor. The interest rate and the payment is like the most important thing. It's the thing that's going to allow you, because that's going to be fixed for 30 years. And as the rents go up, then you're going to have the spread between, it might start off as $100 a month, but if the rent goes up by 50, then 100, then 200, your payments staying the same. So that's really smart, that's to find a way to really negotiate the most important thing, not only the price, but also the interest rate. Now you have these new construction rentals that cash flow when they wouldn't have unless you would have put more money down at that point.
Right. Absolutely. And it's not, like I said, it's not going to be, amazing cash flow. One thing I also like about new construction is the property taxes are very low the first year, because you're only paying property taxes on the land as opposed to the land and the building on the land. And so, that gives you a little bit of time to stockpile some of that extra money so that whenever the taxes go up, once they readjust for the building, you have a little pot of money set aside so that you can cover that additional expense, because your mortgage ultimately is going to go up once they review your escrow and realize that you haven't been, paying.
And in Texas, that's a big deal, right? But being a no sales tax state, you have actually even higher property taxes than a lot of other states that I see out there.
Yes. I think this one, it was 1.92%, which is lower than Austin. Travis County, Austin's in Travis County, and they're much higher than some of these surrounding areas. But I will tell you that the mortgage, I think about $640 a month is escrowed specifically for the property taxes on this house, or will start being escrowed because we just bought it in July of 23. So we just got our notices recently about property taxes, and we're in the process of, appealing and fighting them and trying to get them down. But
so over $7,000 a year in property taxes, something like that.
Right.
Yep. I've got this little rule of thumb. I don't know if you remember us talking about this, but I always look at it because I'm looking at the students all over the country. It's like typically like a good rent to property tax ratio might be, for me, like in South Carolina, if I have a property that rents for $2,000 a month and the property taxes are $4,000 per year, that it would take, I think about it this way, it would take me 2 months of rent to pay the property taxes. And usually 1.5 to 2 months is kind of a typical number I see for my rental properties. And then I often when I see Texas has a lot of other benefits too. But you might have, for example, what is your new construction rental in Texas rent for? What is that, the monthly rent?
$2,150 a month.
Right. So in your case, $7,000 or so in property taxes per year, maybe less if you can negotiate it down, but 2,000 times 3 is 6,000. So it's like 3.5 months of rent. So, again, you gotta weigh all the different things about a property. No rental's perfect, but yeah, for those of you investing in Texas, other states, I'm trying to think, Washington State is another no income tax state that I've seen higher property taxes. It's just, got to run the numbers. And something I'm keeping score here, Alicia. You have a rental in Mississippi, a rental in Texas now, a rental in Austin. So you have two in Texas, one in Mississippi. You got your primary residence. So you've built a little portfolio here. You've got the small, mighty portfolio of rentals, 3 houses, plus your primary residence. And had you used all of the cash from the Florida sale at this point, or do you still have some gunpowder left over?
Still have some gunpowder left over. We used about half of it because one thing that people need to know if they want to invest in Texas is, and I've accepted this, you're going to have to put at least 25% down in order to make the numbers work. So that's what we did with that Lockhart house. We did put 25% down. And Mississippi was different because the tax rate's so low. We only had to do 20% on that one. But yeah, Texas, 25 to 30%, to really, at least for me, to make me comfortable.
To make it cash flow, to where your rent and after all your expenses is enough to pay your mortgage with a little bit of cushion on top of it.
Right.
So just to give people an example, a $300,000 purchase, 10% would be $30,000. So we're talking like 75,000 plus closing costs somewhere in there. So,
right.
So, $70,000 to $80,000 on a new construction is about where you're looking. So all that was my next question I wanted to point out to people is like this pretty property and path of progress strategy typically means newer houses, not major fixer uppers, in a good location where the long-term trends are going well. And you're typically putting a big down payment. Like this is a 20, 30, 40% down payment kind of strategy, whatever you got to do to make the cash flow work. And then you hold on, you're patient. You just kind of see how things go. At this point, are you feeling pretty good about the rentals that you have, the 3 rentals? You've done this pretty quickly. All this has happened, but you're ready to buy more. Even though you've spent half your cash on that, or you're like, okay, this is good. I'm going to do more of this.
Well, yes, Chad, the money was burning a hole in my pocket.
Put this money into the market. Let's go.
Right. No, I had been waiting. I knew, once we had the money, the only thing that was holding us back was the money. So once we had the money, I had to really try to calm down and control myself because I just wanted to buy everything. And my husband, he is the kind of person who he trusts me. And he says, look, if you say it's a good deal, just tell me where to sign. I trust you. I know you've run the numbers 10 different ways and you know what's going on. And so he was completely bought in and he said, well, why don't we try to do, a multifamily? And I thought, okay, well, I guess we could try that. I said, but I don't want to do anything more than a duplex or quadplex. That might be the biggest that I'd want to go. And so that was the next thing. Okay, I'm on the hunt. Where do we want to buy a multifamily? And we also were members of this group called Real Wealth. I signed up. I have like 1,000 emails a day because I've signed up for every possible
you're a deal finder.
Investment club, right? I'm always on the hunt looking for deals. And so we were a part of Kathy Fettke's group, Real Wealth, and it was free to make an account. Yeah. And she also has a podcast and she has properties that she advertises to her investors. And one of those, markets. And one of those markets was San Antonio. And my husband and I, we know San Antonio. We've been there many times and we've always enjoyed it. And so I started looking into that market and they had this builder that it was sort of a family enterprise. So the builder was run by, the husband, the patriarch, and his wife ran the property management arm. And then he had 2 sons. One was responsible for finding infill lots around the San Antonio area so that he could build investment properties essentially tailored for just that customer, an investor. And then the other son was responsible for running the construction crews. And then one of the son's wife, she was the real estate agent that did all the deals for the investors and all the contracts and paperwork. And so they had these duplexes and quadplexes for sale in an area in North San Antonio, really close to 35, called Converse. And it's in an area that's in the path of progress, growing like crazy. And the infill lot that they had was in a really good established area with a lot of good things going on around it, a lot of businesses, a Chick-fil-A.
There we go. Yeah,
Yeah, I don't know why, but anytime I see a Chick-fil-A, I feel very, very confident in my decisions.
They've done their homework. Yeah, it's like following the Starbucks, but follow the Chick-fil-A. Yes.
Exactly. And I think there was a Starbucks too, very, very close by. And so my husband and I we looked at the lot that they were going to build on, and there was only going to be 15 duplexes on that lot. And there wasn't anything nearby, no duplexes. The only thing they had nearby was an apartment complex, but the apartment was, six levels high and just a very massive apartment complex. And it was just sort of okay. And so they showed us the product that they had already built in various areas around San Antonio. And they had a pro forma. And essentially what they were willing to offer is a 10-year ARM, but it was amortized over 30 years. And you could get a 4.25% interest rate. So that was fixed for the first 10 years. And then, year 11 on, the highest it could go would be 9.25%. So you were capped at 9.25%, from years 11 on. And I did the math on it and I thought, oh my gosh, we could cash flow like $650 a month, even after property management, pity. And I thought, this is cool. Like there is a little bit of cash flow in Texas. And so we pulled the trigger on that deal.
Awesome. So you went down, you looked at it. And so what were the numbers on this one? We're kind of going around all the different properties. What were the price and what were the rents on these?
Sure. So the price on this one was $515,000. This was another 25% down deal. In fact, I think that was the deal in order to get that 4.25% rate. And the rents they estimated were $1,750 per side. So in total, $3,500 was estimated.
Got it. Okay. So again, like if they're looking at lots of deals out there, the profile of this deal, you're doing your homework on locations, low maintenance, but the ratio of rent, 3,500 to 515, it's, if I did my math right, it's like 0.7, somewhere like, instead of the 1% rule. It's not the 0.5% rule that we were talking about earlier, which is really tough to make cash flow, but if you're like 0.7, then you put a big down payment in a good location, it's possible to at least break even, especially when you get a low interest rate and you can hold on. So again, the strategy, after it's all said and done, you have 3 rental properties that are single families. You now have this duplex. You've deployed, over $100,000 worth of capital in that last one. So you've got most of your capital out there. And maybe could you talk about the strategy? So some people might be saying, well, you put all your cash in this deal and you're not making a lot of cash flow. You're making you can't live off $100 a month. Like what's the long game? You always have a game plan here. So how does one benefit from this type of strategy that you've done over the last couple of years?
Well, our thought about this one is it's really another appreciation play, because some people may think a duplex only getting like $600 a month in cash flow is not really that great. But in Texas, I think it really is, because within the next 10 years, this particular property they believe it will double in value. So, if we decide to sell at year 10, we're looking at something that may be worth over $1 million. And by that time, we'll have paid down, a chunk of the principal. And, in addition to getting at least the $600 a month in cash flow that entire time. Right. And so the big payoff to us is, okay, once we sell this property, we can move that money into a quadplex or a small apartment complex. So our goal was, in the future, buying or being able to put down a significant down payment for something even larger that may cash flow more. So that, that's not something that we have right now. We don't have $250,000, $300,000, $400,000 to buy a quadplex that's $1 million right now. So that was the goal, is future appreciation.
Exactly. And in my own words, I think you're exactly right. Like, you know this, but I always put it in like 3 different stages as a rental investor. You're in the starter stage when you're just trying to get your first property or two, learn how to buy properties. And then you get to this wealth builder stage, which my opinion is y'all are like right in the thick of it. You know, you're right in this great wealth building stage. And then eventually you get to this harvester phase where you start taking your equity and trying to turn it into cash flow, and you start trying to live off your cash flow. But so many people get ahead of themselves. They're like, oh, I want to make the cash flow today, instead of strategically thinking. What you're doing, I think, so well, Alicia, is that at the very beginning of your story, you didn't even own rental properties, but you were building your net worth. You're paying off your debt, which was increasing your net worth. You've gone from negative to positive, and then you lived in homes that made you 6 figures. And then you've just been trading your equity into the next property and the next property and the next property. And as long as you buy quality assets, you now own, well over $1 million worth of properties. And the game plan is, and I have another friend in Texas. I don't know if you know Arion Shihai, who's been on my podcast several times. He's a real estate agent, and he does the exact same strategy you do. And he went back and looked over the last 10 years of his clients, and no matter whether it's a cash flow property or whether it's more properties like this, almost 70-80% of their gains, of their profits, almost always came from the growth of the equity. So yes, cash flow is important, and eventually you want to make cash flow. But if you want to grow your net worth, if you want to go from a couple $100,000 to $1 million, then is having a strategy like this, or having another strategy with cash flow where you reinvest the cash flow. And so, like, I guess what I'm just validating what I think your strategy is that you're in the growth phase. Therefore, you're planting seeds with your capital, and you're buying quality rental properties. And then 5 years from now, 10 years from now, you can then hopefully, make different decisions. You can sell properties, you can refinance if you want to, you can maybe sell one and pay off another if you want to. Like, you can start shuffling the chessboard a little bit at that point, but you're playing it well. You're planting seeds, which is the whole game. You're locking in low interest rate loans for a long period of time with properties that tend to go up in value. Who knows exactly when they will, but if you're in a good location. So I just think it's so cool, Alicia. I think you're playing it in a very deliberate, consistent way. And I think it's pretty cool.
Thank you. I'm a strategizer. I always have been. I mean, that's one thing I loved about when I actually practiced law for nearly 10 years in South Florida. And I did a lot of mediations, and it was my favorite part of the job, just strategizing and trying to figure out what the other side was thinking. So I do the same thing in my personal life with my investing, as I strategize and I think about, in the future, 15 years from now. That's my goal. Is I would like to retire at 59. I want to retire before I'm in my 60s. So I'm doing a double strategy. So the real estate is one strategy, but then I have a 401k with my job at the insurance company, and I contribute 7%, and the company matches it. So I have 14% of my income going in to this 401k. And so I'm hoping between the two things that, maybe I can take some vacations when I retire, instead of, living I guess government social security check to social security check, like a lot of people I see.
Yes.
And I also added becoming a realtor in Texas onto the many things that I'm doing.
You are busy, Alicia. So, you've got a lot going on.
I do. Yes. So property management of my own rentals, the day job at the insurance company, and then the realtor job on evenings and weekends. And it's exciting, though. I never have a dull day in my life.
It's a lot of fun. And well, congrats to what you and your husband have done. I would love to ask you just this question as we step back from this. People have heard your story, and thank you for sharing so many details about it. If somebody is in the thick of their own journey, whether they're $200,000 in debt, or they're just kind of in that house and they're just trying to make their way up through the muck and mud to try to make the next deal, and I'm thinking more like this psychological game here, but do you have any advice for them that helped you kind of get through that journey that you've taken that might be helpful to them on their own journey towards financial freedom?
I think my advice would be to just take action. You can sit and run the numbers all day for days and days on end, but until you actually put the plan in practice, you don't get any experience. You don't know what it's going to be like. It's sort of a pipe dream. And taking the action and actually getting into the game helps you understand and get better. And for me, in the back of my mind, I always think, is this possible? Is it possible that I'm going to fail or something bad's going to happen? Sure, it's possible. But I think writing that down or, taking note of that these are all the bad things that could happen, and then preparing yourself, you already know what bad things can happen. So you can still take action knowing that these things could happen. And for me, it gave me comfort to have a strategy on how to handle those things. And then your excuses are it should be none at all, because you've thought about the bad things that could happen. You've strategized on what you would do if they did. So, at that point, you really have no reason not to pull the trigger.
Good advice. I love that. And I want to give you a chance. You've got a lot going on, Alicia, both as a real estate agent. I forgot about that as well, an attorney. But if people wanted to connect with you, follow up with you, send you a message afterwards, I'll put a link to all this in the show notes and the YouTube description, but let people know where they can follow up with you.
Sure. So I'm on Facebook at A Wilson REI. And then I have my realtor website, Alicia Wilson at exprealty.com.
Awesome. I'll have links to all that. Thank you so much, Alicia. This has been a lot of fun. I really enjoy your story, and I can't wait to see what's next with you and what the next property will look like. We'll have to have a follow-up conversation and talk about that as well. So I hope you have a great one, and we'll see you soon inside RPM.
Thanks, Chad. Have a great day.
You too. In this interview, Alicia shared how she made a lot of money renovating and then flipping 2 of her homes. But what we didn't share was how to actually budget and estimate cost for those renovations. So in my next video, I chat with a contracting expert, Dawn Matesy, with some insider secrets about how to estimate and how to budget for your next renovation project so you can keep it profitable. If you're watching on YouTube, you can click on the thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. I'll see you in the next video.